The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. So, George, good to see you. Things are interesting out there at the moment, are they not?
Hey there, Ian. Ian, I have to confess, I've been on a break this week. Now, when I say break, I mean my laptop was broken. So my view from this week is really very much from afar. But from that afar, there's been some lovely things going on. So firstly, we had from a tech macro perspective, we had that policy flip. China's off the naughty step. We've got lower rates. Suddenly, boom, cue a market rally and everything's great. Techmark 100 is in positive territory now. Index 1.3. NASDAQ is on 1.4. Even Bessemer, the cloud index, minus 1.2, but that represents a massive recovery. Stocks, we have mixed and hurt feelings this week. So we had from software, a nice print from Sage. It's always sort of in line for full year. They reiterate guidance at the H1 print, did the same today.
Well, last set of results, they reacted quite nicely, though, didn't they?
That's right. But classically, folks like to take profit on results day as it rallies into it. And what happened on the full year is that they didn't rally into it. They just kept on going. But I think today people were looking for a little bit more from Sage as it guided in line. But worse on this one, the insomniacs amongst us will have spent last night watching the finals over the cloud guys at Xero. And from that, you would be starting to fret about sort of, the ongoing recovery at Sage. Now, one of the issues for Sage is really how do we look at Sage? So is it A, a UK tech company on the dividend list, or is it B, part of the international set? And although London likes to price it as part of the globals, the KPIs at Sage don't really match the globals. So today we had, let's say, rule of 40, Sage 29, Xero 46. Xero had struggled over the past few years, lots of new management changes, but now we see momentum returning, bit of a bounce back. Xero revenue growth 22%, Sage 9.5.
What about within Intacct?
So Intacct has been the star performer for many years. They continuously bang out 30% growth. That is still the case. Looking at Sage's domestic market, i.e. the UK, Xero popped out 25% growth, now at 1.2 million subscribers here in the UK. The best that Sage in the UK can do is 9%. We see Xero shares go up 5%. We see Sage's shares fall by the same amount. So they've got a struggle there in terms of really reading the room. And I think the lesson from the room is start to emphasize growth initiatives. And what Sage did is that it extended its share buyback.
But are we not being a bit harsh if we're comparing it to Xero? Sage is competing against accounting software, and it's competing with larger competitors with big, sophisticated products. To a certain extent, Xero is competing against Excel and a brown paper bag.
That is a great point, Ian, in the sense that there is a bit of market difference there. However, let's sort of pull Sage away from Xero, let's say a cloud native, and really look at it relative to what it is, which is a desktop company selling globally, for want of a better word, and then moving to the cloud. Companies that are going through that transition, say an Intuit, say a Visma up in Norway, Team Systems, back to the UK, and Iris, even the likes of SAP, Wolters Kluwer in the Netherlands, we're seeing from that pack of companies far superior take-up of the cloud platforms. So their migration from desktop, i.e. sitting under your desktop, has been a lot better than Sage. So today, for example, Sage, data point, 34% of revenue is attached to cloud native. Now, for that trailing pack of companies, big global desktop to cloud, that average is 60%. So they've got a lot of work to do on that front when you're comparing them with that sort of, global group. But I do take your point entirely. Xero is a cloud native product. Sage isn't. But for me, even against those similar companies moving desktop to cloud, Sage doesn't really match up on a KPI basis.
And should we read in a negative read for the UK because of who Sage's customers are? Is that indicative of the nature of their customers and where they're based and where they operate?
Excellent point, because I think a lot of people, our experience of software is enterprise systems. And then Sage is unique because it doesn't sell enterprise systems. It sells into the SME community. And as you know, revenue is fairly matched 50-50 between the S and the M's. It doesn't have any E's at all. And then when you think about sort of the underlying dynamics of the SME world, you can say, well, they are different than the sort of, the enterprise. You've got different buying types, but also they want different things from the underlying product set. Now, what you can do then is put together a picture of this is what we're seeing from SME focused companies as opposed to what we're seeing from enterprise focused companies. So one of the attributes of the enterprise market at the moment is that the sales cycles are extending. There's a couple of extra loops in there. Now, at the same time, in terms of the SME world, and here I'm going to flip back to you, Ian, we're starting to see issues percolate up from the growth economy in terms of, where is the engine room? The engine room is in SMEs, but we're seeing results from Bytes, which is also talking about more difficulties in terms of the SME world. What are you seeing there, Ian?
Well, we had an interesting one from Gamma, which is that earlier on the year, they did highlight that the business division they have, which sells to the SME space, so that was not seeing the progress that perhaps they would hope for. And now, in a trading update this week, they extended that commentary across the entire UK space, and that includes the enterprise and potentially into the public sector space too. So it is an interesting set of developments, should we say, but interesting to contrast with what's happening in their German operations, where they are doing things. They've recently made 2 acquisitions, Playstyle, Starface, and where they have done deals, they're putting product sets together. They're seeing strong growth there. So despite the fact that the German economy is in a bit of a terrible state, if you are innovating and you're doing something different, it is still possible to grow the top line. You've just got to keep innovating and changing things. That's always the challenge, though, isn't it, in tech?
A very good point on keep changing, keep innovating, but also in terms of Germany, because there's also a lovely fracturing coming in. I'm seeing that from the professional services side and also from the infrastructure, IT infrastructure services side as well. But probably best for UK investors seen from BAE. And that's all about the rearmament story that's coming out. And we think of it provincially, it's a UK thing, it's a US thing. It's a European-wide thing. ASEA spotted it, flagged it up. Net Company also flagged it up as well. And it's such an interesting area to go into, as for these companies, I mean, a lot of them leaned deeply into ESG, and now to sort of pick that away and say, yep, we're moving from tech for good to tech for killing people. But there is absolutely spending growth in that area. And Germany, of course, being one of the key markets in that.
But it's always been a bit of a nightmare market for the tech companies. It's very attractive. You say, oh, I've got long-term prospects in this business area of defense, but that's exactly what it is. It's long-term. It takes an awfully long time to get products through to market. And then you don't really know what they're going to be in terms of actual revenues. You get promises at the start out when you have your framework agreement with your BAE or whoever else it might be as far as your tier 1, tier 2. But the visibility, predictability, it's just not there.
It's even worse than that, Ian. And as I mentioned, BAE, I'm cognizant that a number of years back, a company that you'll remember well, Detica was acquired by BAE.
Yes.
And we're on a sort of analyst bus tour down to see them in Guildford, and we saw this thing. And this thing was basically a very expensive way to listen to Radio 4. And we could not get what the underlying use case was for the product. And that will naturally make investors nervous. if you can't go back and say, this is what it is, this is what it does. It's also the lack of transparency around this market because there is a general hush-hush.
But it's not unknown for it to get spun to the fact that we can't tell you what it is, therefore it must be very big, therefore it must be very exciting. Therefore, you better get on board now, boys and girls. And certainly, lower end of the UK small cap market's not been immune to a bit of spoofing on that regard.
So that's a very good point. And I have to put my hand up and say, guilty. We had a client, end days selling into the Five Eyes community. And that was how it worked. So the product would be shown. This was a network probe. And then there was a big flurry, almost like a drum roll, and a flag being carried around. And the product would go from the investor meeting to somewhere that resembled a donut. And that was normally yes, crikey, what a great company. I love this. Don't know what it does, but I love this.
I'm sure I understand it better than the other investors. Therefore, I'm going to buy it.
However, one of my big fails was an IPO that didn't happen because there were just too many questions about the product. And I recall a lovely session with an investor, and it could only be on a telephone call. So question, do you use this product? Yes. What do you use it for? I'm not telling you. Do you have any more questions? And the investors just walked away. They said, there's just too much risk. We don't know what it does. Another thing that happened this week is M&A. M&A has sprung back to life. Where was it hiding? In terms of my little list, I've got FD Technologies, TrackMate. Now, these are recommended deals. They're happening. But then we also have AlphaWave. We've had Impressa. We've had Deliveroo. What's going on?
I don't know. I think there might be some value in the UK stock market.
What? But you've been saying that for a long time, Ian, and no one cared.
No one cared when I told them there wasn't any value either.
What we are seeing, though, is current deals, sort of the pattern, as you said, is unchanged. UK is cheap, absolutely. But also the other side of that, if you're a seller and you want to maximize shareholder value, you have to go to a trade buyer. If you want speed and get it out cheap, then you have to go to PE. PE continues to pay 30% on top, i.e. to the undisturbed share price, and trade will pay between 45 and 50%.
Well, they know what they're going to get. They understand it. They don't have to do the due diligence. And we talk about due diligence occasionally. And the PE guys have to do more due diligence than the corporate buyer.
I'm going to take you off that hobby horse because you flogged that one long enough. And on that bombshell, Ian, once again, a revelation. And thank you so much for spending your time and thoughts. How lovely.
Well, thank you too.
Brought to you by Progressive Equity.